you invest in a corporate stock, do you know the company's financial situation? Understanding the corporate balance sheet will allow you to make an educated decision on the financial health of a company at any given point. I am Craig McCormick, and I have taken 3 college courses: business accounting, business finance, and business mathematics, that will allow me to teach you how to read a corporate balance sheet. Jim Fink, in the article How to Read a Corporate Balance Sheet when Comparing Financial Statements, states, "The balance sheet offers a reflection of the entire company, a full body scan in medical terms." In the book, Financial and Managerial Accounting, it states, "The balance sheet lists the accounts of the company's assets, liabilities, and owner's equity at the end of the accounting period." Assets are resources which are owned by the company and have a monetary value. They include current assets, which are resources that will be consumed or turned into cash within 1 year. Cash are monies on hand or in an account. Accounts receivable are monies owed to the company by customers or other individuals. Inventory are raw materials or finished goods that a company has in stock and are ready for consumption or sale. Prepaid expenses are expenses that have been paid in advance, such as insurance. Building and equipment. These are buildings and equipment that will be used for more than 1 year. Buildings are facilities owned by the company minus their depreciation value. Land are parcels of land owned by the company which do not have a depreciation value. Equipment are equipment used in the manufacturing process minus their depreciation value. Liabilities. Jeffrey Slater, in the book Practical Business, states that liabilities are debts or obligations of the company. Current liabilities are liabilities that will be paid within 1 year. Accounts payable are debts from creditors. Salaries payable are obligations to employees which have not been paid. Long-term liabilities are liabilities that will not be paid within 1 year. A mortgage notes payable is a loan on the buildings and land. Capital note payable are loans on a capital equipment that the company owns. Stockholders' equity are rights and interests of the stockholders to the organization. They include common stock, which are monies paid by investors for stock in the corporation, and retained earnings, which are earnings from revenue that will not be paid as dividends or capital expenditures. In the article, The Beginner's Guide to Financial Statements, it illustrates the formula that summarizes what a balance sheet shows. Assets equal liabilities and stockholders' equity. Okay, here's a look at a company. It's McCormick Classic Car Corporation. The balance sheet has a specific date. This is the picture of the company as of this date, the financial status. They include the assets, the plant and equipment, the liabilities, current liabilities, long-term liabilities, and stockholders' equity. The key is the total assets equal the total liabilities and stockholders' equity. In the book, Foundations of Financial Management, it states liquidity ratios, analyzes the firm's ability to pay off short-term obligations as they come due. In debt utilization ratios, the overall debt position of the firm is evaluated in light of its asset base and earning power. Financial ratios measure the company's liquidity and debt utilization, which allows you to make an educated decision on the financial health of a corporation. The current ratio is the current assets divided by current liabilities. So this ratio for our company is 2.17. So every 2.17 or $2.17 in assets, there's $1 in liabilities. Quick ratio is current assets minus inventory divided by liabilities. So we have current assets minus inventory of $1.10 for every $1 of debt or liability. Debt to total asset ratio equals total debt divided by total assets. So 40% of our assets have debt towards it. These are all three solid ratios in investing for a company. So we have covered the corporate balance sheet. We've reviewed liabilities, assets, and stockholders' equity. We've also looked at the financial ratios, the liquidity ratios, and the debt ratios, which include the current ratio, the quick ratio, and the debt to asset ratio. So putting these all together will allow you to read the financial health of a corporation before you buy their stock, and will make you a better investor.